Yeah, it's uncharacteristically abnormal time for our sector, really going through this market. I mean, obviously everyone's focused on the resources. Adrian just pointed all that out as well. But our space should definitely catch a bit. I mean, this is, as Lisa pointed out, it's a very volatile market. I mean, things haven't really changed for us as far as inflationary trends, what's happening with the Feds, where they're going to move interest rates. We have the war ongoing. Dare I say, the COVID pandemic is still there. And maybe even monkeypox. I wasn't going to throw that in. I said at least I wouldn't even mention it, but I'll do it anyway. Call me offline. We'll discuss that. Anyway, don't lose any sleep is the bottom line from that. Neither here nor there. But the whole point is it's a volatile market. We don't know what to do. And I think it's a good time to look at some of these really high quality core portfolio holding names across healthcare. And I'm just going to want to point out just a handful here. So let's start with CSL. This has really struggled throughout the whole pandemic. It's really trading sideways, not really going anywhere. It was really on their blood plasma fractionation, supply constraints, increasing costs, but they look to have turned the corner. So it's been kind of, as I said, flat trade for 2 years now. I think things are coming right side for that company. It's trading below its normal historic multiple, and it looks like things are improving. So I like it at this level. I'll be chipping away definitely for looking at CSL. Cochlear, I don't really mention a lot of times because it's such an astronomical high PE multiple name, but it's a stellar quality name. It's putting up the best ROICs across our space. It is up actually 8% since we upgraded that name back in February, but it's down 5 off the 235 level it was last month. But what they had is they're dealing with some capacity issues and constraints there and some headwinds on their cost. Give it a little bit of impulse for cochlear implantation. That being said, you do have this huge, enormous backlog that is going to come through, come hell or high water. So I'm still looking at Cochlear as a really good, strong portfolio holding name. I would prefer it below the 220 level. If you can pick it up, that looks like good buying on Cochlear. And ResMed would round out our core holdings. I've talked about this before ad nauseum. It is a quasi-tech name in a market that tech is a dirty word right now, unfortunately. So it's been kind of monkey hammered down here at these levels. It hasn't really come up since its Q3 report. But things are improving for ResMed. There's so many flying in the air as well. When we see them exiting into fiscal 23. Now we're in Q4, obviously. I think that's going to be a harder quarter for them. So I'm thinking you chip away here, but be cognizant that this quarterly report is not going to be the best that I've seen. But looking further afoot into 23 into 24, you're going to have some more opening up and some more earnings growth coming through there. So I like ResMed at these depressed levels, given that, as I said, the tech kind of sell off. But what I really wanted to flag this morning really is kind of what represents, as Elisa said, kind of our key pick and the most upside potential across our name, and that's Helios. As I said, I've talked about this a little bit before. It's a diagnostic player, a core domestic player in the diagnostic market, number 2 outside of Sonic. But then the name really represents really upside to us, 20% upside to our price target currently trading at fully franked 4% divvy. Just for your effort, and I'll throw in it's trading below a market multiple at 14 times forward earnings. Looks really interesting. Other reasons why we like this name. First, nothing really earth-shattering came out of its strategy day that was a couple weeks ago. Really, costs remain elevated. These are COVID-related costs. People withholding surgeries or not going to surgeries, not having the diagnostics done due to COVID. That's alleviating us, obviously. We do still have supply issues as well as labor costs, inflation as well going through there. But the good positive thing here is earnings are slowly improving. COVID testing is averaging in this country 16,000 a day. Yeah, 16,000. That's not insignificant, and looking to stay here for at least a while. Where it settles out is anyone's guess. It's kind of all over the map, but nevertheless here to stay. Influenza, all you need to do is look around the room, people coughing and sniffling. We all had our kids, ourselves sick with the cold. That's coming back. That's remaining elevated. It's up 4 times in the last couple of months and looks like to be elevated throughout winter. So what does this all mean? It means Helios is going to ink the biggest earnings I've ever seen increase, 150% on the PCP. So doing quite well. Second, the company continues really its evolution really to become this scaled digital operator in the diagnostic space. This is really centering around its initiatives to unlock AI, to really drive superior clinical benefits across its portfolio. Operational efficiencies, it's eking out across its pathology division. That is 85% of this gross profit of this company. Then you also back that up with the diagnostic imaging. That's the other quarter or so is in there as well. And they're building out strategic initiatives in other verticals and adjacent growth areas. The balance sheet is the best shape I've ever seen at this company. I'll put in perspective, 49 times interest cover. That's unheard of. The third thing I'd like to point out, the company is running what's called their Sustainability Improvement or Sustainable Improvement Program, SIP. This is merely a systematic cost out and efficiency program. They've run this for a couple of years. Why do I bring it up? Well, I bring it up because it's stripping out huge amount of costs out of this business. They've already inked $70 million as far as cost out. That's 5% of this cost base. It's already locked in, bank that. But they're looking for another 67 million of savings exiting fiscal 23. What does that translate into? Translates into a 300 bip margin improvement in their earnings, exiting, as I said, fiscal 23, and that looks on track. It looks on track is key point that was brought up in the strategy day. That was contrary to a lot of analysts, a handful of analysts came out prior to this strategy day, said that program was slipping. They ate cake. It was not slipping. It is not slipping. Management, as I said, reiterated that it's on track. What's happened with those analysts or the stock, they moved from $4.50 to below $4 on their assumption that it was going to slip. The stock has since recovered halfway, 4.25, so it has more way to go. So obviously here, I see a clear execution risk. There's a lot of balls in the air as far as them going and evolving into what they want to be when they finally grow up. Underlying fundamentals, I don't have to tell you. It's unwavering. We still have really strong growth thematics. We have the technology improving. We have, the aging population, chronic diseases, and dare I say pandemics. Yes, get used to them. They're going to be here with us forever, and they always have been. No big deal. And the valuation is quite attractive. And let's not forget that there is a bolus of undiagnosed or underdiagnosed people out there that will need diagnostic testing done as well. So that's all the reasons why I like Helios. And Lisa, if I may, since I have the floor, it's a couple minutes. I did want to point out, just in light of a continuing battle for Virtus by BGH and Cap Vest, and I see that Scott put out a little flash note. I think I want to draw your attention to it because it seems that the board of Virtus is recommending the BGH offer at $8.15. And this is important because it seems like that offer is only applicable to today. So if you're a shareholder, you have clients that have shareholders, get on the phone. You have to tell them that they have to tender their shares for that offer today. Don't ask me why it's such a short notice, but all the details are in that flash note that Scott put out. Or happy to talk to you offline about that. But anyways, that battle kind of goes on, and now it seems like BGH has the upper hand. I just wanted to highlight it Ramsey because it's an interesting ARB play here. And we all like a nice little ARB play. And it's also a safe harbor to park some cash in this volatile market. Now, KKR lobbed, if you remember, an $88 bid last month, and that represents 13% upside from current trading levels. We see downside risk if this does fall over of 10%. So obviously it's skewed to the upside, around $70 if it falls over. But what's the chance of it's falling over? Now, KKR has courted this company for years. This isn't anything new. They've insulated themselves. They've backed themselves with super funds in the consortium. So they're not stupid. And they also have the blessing of Ramsey's largest shareholder, the Ramsey Foundation, or roughly 20% of that register is backing them as well. So I wouldn't expect them to pull the pin. Yes, they're doing their due diligence. Yes, they're in the data room. But unless they find a smoking gun, never say never. But Ramsey operates a very clean, very open, transparent financial books. I always have no problem with Ramsey, so I'd be very surprised if things fell over for lack of financial, something that they found in those. I see more upside. And I said before in multiple notes, $88 looks a little bit opportunistic. Well, why not? KKR is not going to lob a huge, massive bid. But maybe the board from Ramsey decides to nudge it up a little bit into the 90 range. Wouldn't be anything unusual, I believe. But maybe the board will just capitulate. This is a 35%, or it was a 35% increase off of the trading levels prior to the bid. And since this has essentially been dead money for years and investors are extremely frustrated with this, maybe the board just capitulates and says, hey, $88, I'm gone off the table. But whole point, more upside than downside, nice little R play, park some cash there, Ramsey.